We have a big task in front of us now in attacking this reading on the analysis of active portfolio management. So if you are getting ready for bed and you thought, hey, I'm going to watch 15 or 20 minutes of Holmes doing video before I fall asleep, this is not the reading you want at this point in time. So it's sort of like tackling, consolidation of foreign subsidiaries, not something you want to do on an empty stomach. Okay, well, the same thing would apply here. So this is actually a really involved reading. It's got lots of formulas, lots of ins and outs, and it is intuitive. But it's only intuitive on the other side of understanding, having a really good understanding of portfolio arithmetic, portfolio math. So there's just a lot of formulas here. So you're going to have to approach this, and it is, I think, extremely testable. So and it's long, so I think it's going to be. It's important that you get on top of this. There's two ways to approach it. One is to go back and, well, if you already have a degree in statistics, you're an actuary crossing over into finance, that's great. Then a lot of this is going to come really easily. The other way is just to say, I'm going to have to memorize some formulas here. Now, generally, I don't think you can memorize your way into a charter. The CFA exams are different. You have to understand, and you're going to have to understand the intuition of how all this fits together. But the formulas are not obvious for most people, at least as they're starting out with this. So this might be a place that you just want to make a formula sheet. I decided that before this presentation, before I recorded this, that I was going to make a little formula sheet too, just to make sure I didn't have any holes in my understanding. And I think the formula sheet ended up being 5 pages. Now, I write big and I leave lots of space, so don't panic. But nonetheless, this is a reading that's going to take a little bit of time to get on top of. It seems to me to be kind of the heart of the portfolio management stuff at level 2. So it's something that you're going to want to be careful with. Anyway, so the reading's focusing on this idea of the fundamental law of active management. And what the law really says is that we can break the information ratio down into 2 components, and we're going to be focusing on this idea of the information coefficient. We'll see that in a little while. So this is Grinold and subsequently to that Grinold and Kahn that developed this idea. It's further developed by these guys, Clark, De Silva, and Thorley. One of them is a faculty colleague of mine at BYU. Actually, technically, I'm his boss since I'm the department chair. I went and talked to him about this before recording, just to make sure that I had the nuances of the intuition. And he got lost twice in the mathematics as we were going through it, or not really mathematics, in the arithmetic. So if the author can get lost twice, then those of us who are trying to get ready for the CFA exam can be forgiven for thinking this is a little bit cumbersome when we get started. So anyway, Steve, why did you throw all this math into this reading would be a good question to ask. Don't worry, he's out of the raise pool for the next 5 years, so there'll be no Thorley raises going forward. Anyway, but the idea here is we're going to focus on how an investor should construct a portfolio given an assumed competitive advantage. And what that says is that we are going to work under the assumption that the markets are not perfectly efficient. There are people who can identify mispriced securities, either over or undervalued. And then once we do that, how can we construct an optimal portfolio? So, and it's really, we're going to do it in terms of an active managed component and a benchmark portfolio. So we're going to be combining those 2 things to get an optimal portfolio, and then from there we can adjust however we need to. All right? So active management and value added. Remember, what we're doing here is we're charging, if we're portfolio managers, we're charging people to either engage in sector rotation, factor tilt type stuff, or security selection because we think we can do it better than the market overall. So pretty gutsy claim to begin with. But what we're saying is, look, the return on the portfolio is going to be greater than the return on the benchmark. That is, we're going to have positive value add. So if the return on the benchmark is 12 and we can earn 12.75, then we added 75 basis points of value to the portfolio. As long as that's less than our fees, then we are okay. If the market goes down by 9% and our portfolio only goes down by 8%, well, then we've still added 100 basis points of value, right? We went down, but we didn't go down as much as the market. So if the portfolio returns greater than the benchmark, we're adding value. portfolio return is less than the benchmark, then we are destroying value. And of course, we're not going to bring the discussion of fees into this, but really it's the portfolio return after fees. So passive investing is just holding the benchmark, right? So I am for the most part, a passive investor. I invest in index funds and have a real focus on cost management. I realize there's those of you that don't like that strategy. Anyway, but that's what I do. So if I do hire an active manager, well, if I'm going to pay you to select securities or do factor tilts, you darn sure better beat the benchmark, because I can get the benchmark portfolio almost for free, right? So anyway, so benchmark qualities, there's lots of things we could benchmark to. Think of for this reading, we're not going to really investigate them, but you can think of this as a market portfolio, and that is the S&P 500, right? So large cap, U.S. domiciled, and it's going to have some qualities that make it a good benchmark, right? So the benchmark has got to be representative of the assets from which the investor is going to select. So when they say investor here, you can think of the portfolio manager. So if I'm benchmarked to the S&P, and I'm over here choosing, investing in VC funds and that type of thing, well, then the S&P is not representative. So we need a benchmark that is representative of the types of assets that the manager is going to buy. It needs the benchmark should be able to be replicated. So we could just go in and buy all 500 securities. You can replicate it relatively easily. Okay, and then the benchmark weights are verifiable ex ante, and the return data is timely after the fact. And of course, the S&P 500 would meet all of these. Well, it would certainly meet 2 and 3. This is actually a qualitative judgment. So is your manager actually choosing from large capitalization U.S. domiciled stocks or firms? Well, then that would be representative. But those are the qualities that we will want in a benchmark. But that's not the point of the reading here, right? So we've talked about how you replicate indices and all that sort of stuff elsewhere. So let's just think of this as we're looking at a manager, and the benchmark is going to be the S&P 500, and we're not going to change any systematic risk elements. And that's really addressed on this slide. So this is the ex ante active return. Right? So that's going to be the expected return on the portfolio minus the expected return on the benchmark. What you've seen, or what you're used to seeing in this context, is to compute it ex post, and that's this equation. So the risk-adjusted active return, or our alpha, is going to be equal to the return on the portfolio minus the beta of the portfolio times the return on the benchmark. So if the return on the benchmark is 10%, okay, the return on my portfolio is 11%, but I got an 11% return, but I really increased systematic risk, right? So this portfolio has just massive exposure to changes in the markets. Well, that would say we have to take the beta of the portfolio, 1.5, times the return on the market, okay, and that would be a risk-adjusted return. So this would be the return you could get if you just levered up the benchmark, right? And this is the return I actually got. So in this case, they would have negative alpha because I had a return higher than the benchmark, but it wasn't high enough to justify the fact that I took on a bunch of additional risk. So if you want to, in the old days, there was the scam where you could send out 100 letters to people, and you'd say, well, I think this stock is going to go up over the next week and to 50 of them, and this stock's going to go down to 50 of them. Well, if it went down, well, you just took those 50 people out of your sample. And then the second week, you had 50 people. You told them a stock was going to go up last week. This week, you say, okay, this stock's going to go up to 25, and the stock's going to go down to 25. Well, if it goes down that week, then you throw out those that you said is going to go up. Now you got 25 people that you've given them 2 accurate stock predictions, and then you try to sell them products, right? So if you want to do the same thing as an active manager, well, just manage 2 portfolios, take, double down on, systematic risk, return on the market. If the market does well, okay, well, then your portfolio is going to go up in value, the one that you've got lots of risk on. If the market does poorly, you're going to lose a lot of money, but you got 2 funds, right? So then you get rid of that one and just focus on the other. Anyway, the point here is you can't just lever up and then not include that in your calculation of alpha. So if you take a lot of risk in the benchmark, then you've got to make sure that the risk is manifest when you calculate alpha. Okay, now here's the kicker, and the reason I'm not really going to be concerned about this going forward. We're going to assume that the systematic risk of the portfolio is the same as the benchmark for the rest of this reading. So we're going to assume that this is equal to 1. The beta of the portfolio is equal to 1, or at least that the beta of the portfolio is the same as the benchmark. So again, think of the benchmark as the S&P. Okay, and the return on the portfolio, well, this is a portfolio that is intended to invest in things where the S&P would be representative, and we're not increasing systematic risk. We're not taking, we're not buying all of the consumer discretionaries in the S&P and just focusing on that, something along those lines, all right? So measuring value add, this is what we're going to talk about. We're going to look at ex ante alpha, okay, and that's going to be our ex ante active return and then active risk, and we're going to twist it and turn it in about 1,000 different ways, right? So if we want to measure the value added, and then we can just take our active weights, okay, and multiply them by the returns on each of the individual securities that we buy. So these active weights, okay, that comes from the overweighting or the underweighting, okay, of the individual securities in the portfolio. So again, if we had two securities, so let's see, if we had two securities, A and B. Ooh, that's a terrible A. A and B. And the benchmark, okay, weights, put the weights for the benchmark here, are going to be, 50% and 50%, right? And we're going to have the portfolio weights, and I should probably put the weights the other way because that's the way the reading does it, but that'll be okay for now. What if I go, 60% and 40%, right? Well, the active weights then, right? Okay, so the delta W's, okay, are going to be, this one's going to be plus 0.1, and this one's going to be minus 0.1. So the active weights have to sum to 0. You're still investing on, you've got a fund, you got $100, all of it has to be somewhere. Okay, well, so when we talk about active weights, it's deviation from the benchmark weights. Okay, so these active weights, we can overweight some things, but if we're overweighting some things in percentage terms, then by definition, we have to be underweighting others, right? So the active weights are going to have to sum to 0, but if I take these active weights and then multiply by, the returns, so the return on A is, whatever the return on A happens to be, and the return on B, well, if I take the active weight times the return on the asset, well, that's going to give me my active return, all right? So that's all we're saying here. So we're going to have our delta W's. Those are our active weights times the returns on the securities, the expected returns on the individual assets, and that is going to give us our expected active return. All right? So again, the active weight is just the weight that we have in our portfolio, WP, right? So I did it the other way. I did P sub W on my little thing. Don't listen to me, right? So it's going to be WP, so this is the weight on the portfolio for security I, less the weight in the benchmark of security I, that's the active weight, and remember these things have to sum to 0, so what you want to do is overweight things that are going to perform well and underweight things that aren't, right? So you overweight Delta Airlines, you underweight American Airlines. Okay, well, if you're right, Delta does well, American does poorly, well, you're doubled down on Delta, it did well. You lightened up on American, it did poorly relative to the benchmark, relative to, to the expected return anyway. Well, you're going to end up with some alpha there, right? Because you made good stock selections when you were picking your weights for the individual assets. All right, so this is no big deal, right? So expected return is just going to be the sum of the active weights over all the securities times their expected return. Okay, we're going to take this and beat it to death. So as a quick example, though, so we have a portfolio, we have a benchmark, so the portfolio, or the benchmark weights, again, are going to be 50-50. Here's our portfolio weights, 75-25. So our active weights, plus 25, minus 25, remember they got to sum to 0. Well, the benchmark, if we have the return on the asset, okay, is 15%. Okay, for equities, 5% for bonds. So those are the two assets that we have in our portfolio. Well, then we can calculate the benchmark returns. That is, we take the benchmark weight, and we multiply it by the return. Okay, well, 0.5 times 15, okay, 0.5 times 5%, and that's going to give us the benchmark return of 10%. Okay, and then we're also going to have, we can also go through and say, well, let's take and calculate the portfolio return. So in that case, we're going to take 75% allocation to equity times the 15% return on equity, plus 25% allocation to bonds times the 5% return on bonds. That gives us the 12.5% return on the portfolio. Obviously, in this case, again, we're assuming away any differences in systematic risk. The active return is 12.5 on our portfolio minus 10 on the benchmark. We could have also done that by taking the active weights times the returns over here. So our active return would have been, 3.75% in equities minus 1.25% because we can't get all the return because we're investing less in bonds. So we lost 1.25% there relative to the benchmark weightings, right? So we end up with a total active return of 2.5%. So you can calculate it either way. We're going to break it out even a little more as we go through. Okay, so this is just the basics of what we're thinking of in terms of active return. So active return is the active weights times the return on the securities, and that's probably the way you want to think of it. So this slide says nothing new. There's lots of subscripts, okay, but all this says is, look, the weight in the portfolio times the expected return on the individual assets in the portfolio, right? So this is just the portfolio weights times the returns. That's going to be the expected return on the portfolio. This is the benchmark weights, there's the B, times the expected return for each of the securities in the portfolio. Well, this is just going to be the benchmark return, right? So this is going to be the benchmark. In the example we just did, this would have been 10%, okay? And this would have been 12.5%. So we would have ended up with an active return over here of 2.5%, right? So there's nothing new here, just lots of subscripts. Remember, the P is for the portfolio. So that's the portfolio that the active manager has constructed. B is for the benchmark. In this case, the J's, the second subscript, is for the individual assets that we're holding. All right? So anyway, so exactly what we just did, just stated with lots of these scary, spidery-looking summation signs and a bunch of subscripts. So nothing new here, and I don't think a lot to worry about. Now, let's decompose this a little bit further. And elsewhere in the curriculum, we've talked about asset allocation versus stock selection. But here we're going to be a little more specific. We're going to dig in, and in fact, if you're thinking of taking an active return and breaking it down into asset allocation and stock selection, I would not worry about what you've seen elsewhere where they were solving for part of it as a residual. So I would focus on this treatment of how we're going to get to that. So here again, we're going to think asset allocation. That is, look, we have a fund or have a benchmark. It's allocated between stocks and bonds or sectors or however we want to identify that. So we have a benchmark that we've identified. Well, there's two ways that we can deviate from returns on the benchmark. Okay, we can either overweight and underweight some sectors, right? Or within the sector, we can have superior security selection, right? So we can overweight or underweight, transportation. Okay, and then for security selection, within the transportation sector, we could overweight Delta and underweight American, right? So two ways to generate a positive expected active return. Asset allocation, well, that's going to be over here. So this is going to be our active weights times the return on the returns, the benchmark returns, all right? So our active weights times the benchmark returns for each sector. Right, so that would be if we didn't do any stock selection, so we just had stocks and bonds, and we were doing it as two, we were going to take two indices. That was going to be the fundamental securities in our portfolio. One was an index on equities, the other is an index on bonds. Well, let's see, the benchmark's 50-50. All we did is buy them in different proportions. Right? So there wouldn't ever be any deviations between the return on the different sectors from the benchmark to the portfolio. Okay? Well, then this would be all that we had. So it would be active return from asset allocation. We can overweight or underweight equities. But within a particular asset class, within equities, we can also over and underweight securities. That's, of course, called security selection or stock selection. So that's going to be the weight. Notice that there's no delta. Okay? The weight that we put into each of these securities times the active return on that security. So that's going to be the amount by which we think there is positive alpha within the security. So the benchmark expected return would be 10%. We actually think it's going to be 12%. So we're going to pick up 2% active return times whatever weight in our portfolio is associated with that particular selection. Okay? And again, in this case, the weight's going to have to sum up to 100. Okay? And over here, the active weights have to sum to 0. Right? And if you think about, if you're worried about this, so this doesn't make sense to you, why there is no delta in here. It's the weight, not the active weight. Well, if you plug this in, okay, if you plug this in to expected active return, and then you can solve it back, and you see you're going to get to the active return on the portfolio. Not an exercise I suggest. It is correct, right? So you don't need to worry about it. But anyway, asset allocation versus stock selection. So let's take this now and apply it to an example where we can actually plug in some numbers and break down active return into the asset allocation portion and the security selection. So here's a little example. Assume we have two asset classes, stocks and bonds. We're going to have some data on the next slide, and we want to decompose. So the benchmark here has 60% exposure to the bond market and 40% exposure to equity. But this manager is going to be very bullish on equities. So instead of having 40% exposure to equities, he's going to jump all the way up to 70. But if you got 70% invested in equity, then you can only have 30% invested in bonds. So he's going to overweight equity by 30%, underweight bonds by 30%. What we're going to see, given the data on the next slide, is that we have a portfolio that's going, the active manager's portfolio is going to generate a return of 13.2. Okay, and the benchmark is going to generate a return of 8.32. If you take the difference in that, that's going to be the active return, and what we're going to see is that that's going to come from two places. Again, asset allocation and then security selection. So here we go. Benchmark weights, as you see, equity is going to be 40%, bonds are going to be 60%, and the portfolio weights are 70-30. Well, here's the benchmark returns. So the benchmark equity portfolio has a 10% return, the bond has 7.2. So if you take 0.4 and multiply it by 10%, and you take 0.6 and multiply it by 7.2, well, there's the return on the benchmark, 8.32, right? Okay, but in this case, the portfolio is going to have different returns. So the portfolio manager is going to put together an equity portfolio, taking advantage of inefficiencies in the market, and the equity returns are going to be 16.8, okay, and the bond returns are only going to be 4.8. So if you really were predicting that you're going to have lower returns on your bond portion, then you probably wouldn't want to do any active selection there, but don't worry about that. It still makes for a great example. So here's the point. If you take the portfolio weights, okay, that is 0.7 times the return on equity and 0.3 times the return on bonds, that's where you get this 13.2. Well, if you have a 13.2% return on your portfolio and an 8.32% return on the benchmark, then you've created 488 basis points, or 4.88% of active return. So positive alpha, if you want to think of it that way. But remember that this comes from two places. So one, it comes from overweighting, right? So this manager overweighted the higher return asset class, underweighted the lower return asset class, but also selected securities wisely, right? So in this case, for the asset class, okay, the return was, 6.8%. The active return on equities was 6.8%. That is the return above the 10% benchmark return. Okay, and the return here was, of course, negative 7.2 minus 4.8. What we're going to do is break this down into what portion of this 488 basis points comes from our differences in weighting and what comes from our ability to select securities in a superior fashion. All right? So the active return from security selection is going to be our weight allocated to each security, or in this case, each sector, equity, times the active return on that sector. Right? So we overweighted it, but this is the active return. So it's just the active portion of the return. It's not all 16.8, it's just 10. That's 4.67. We see the same thing in bonds. The weight times the active return on our bonds, so that's minus 0.72, and you get 4.04. At this point, we don't really have to do the other calculation. We know we had 488 basis points of alpha. 404 of it comes from security selection, so we really know how to pick equities in this particular money management shop. Okay, so the rest of that 488 basis points, or in this case 84 basis points, has to come from asset allocation. But we could also calculate it by looking at our active weights times the benchmark return. So just the fact that we overweighted, underweighted, even though we hadn't done any security selection, well, we would have picked up 3% with the from an additional 3% from equity because we overweighted it by 30%. We would have given up 2.16% return in the bonds because we were invested there in order to earn that return. So you can see that we would have had 84 basis points from asset allocation. So this manager, okay, has done himself or herself a favor by doing asset allocation. That was great. Okay, but they really did themselves a favor in security selection. The fact that you can earn 16.8 on your on the equity portion of your portfolio without changing systematic risk when the benchmark is only earning 10, well, if you can do that on a consistent basis, the world will definitely beat a path to your door. So what we've done here is we've broken that active return, all 488 basis points, into two components. One is security selection, the other is asset allocation. Notice that this example, just pure, visual here. Okay, so the stock selection comes first, then asset allocation. If you go back and look at the formula, it's written the other way around. The first element is asset allocation, then stock selection, so don't let that confuse you. And I only bring that up because it confused me the first time I looked at it, right? So anyway, so just a decomposition example here. I don't think that's anything that is gonna bug you too much. Okay, Sharpe ratio. You've seen the Sharpe ratio before. It goes all the way back to level 1, widely used metric, all that sort of stuff. And all we're doing here is measuring excess return per unit of risk. So we're taking the return on the portfolio minus the risk-free rate, dividing by the standard deviation of the portfolio. And this is, so the excess return is the return on the portfolio minus the risk-free rate. Okay, dividing that by the standard deviation of the portfolio, it's excess return, right? So the numerator here is excess return. And you got to be careful because we're going to throw around several terms here, right? We're going to talk about return or total return. We're going to talk about excess return, and we're also talking about active return. This is not active. This is excess. Right? And we use this a lot in finance. So excess return is just the return on any asset or portfolio minus the risk-free rate. And the idea here is, if the return on the portfolio is 10% and the risk-free rate is 3%, well, we have an excess return of 7%. Well, all of the volatility in that portfolio was assumed in order to generate the excess return of 7%, because there is no risk here for the risk-free rate, right? So if you just want to earn 3%, then you don't have to worry about bearing any risk. So what we're looking here is that the excess return, that is the return we earned because we were bearing risk, return above the risk-free rate, and then comparing that to the risk of the portfolio. Now, a couple of things here. One is this is an absolute measure. Notice that there is no mention of benchmark returns here. And also, this is unaffected by the addition of leverage or cash, right? So the Sharpe ratio is not impacted by whether we're holding cash, because if we're holding cash, that assumes we invested in the risk-free rate, right? Then we're going to see the excess return fall, but then the standard deviation will fall proportionally. So numerator and denominator will change proportionally, so there won't be a change because we lever up or because we lever down, we start holding some cash rather than risky assets. All right? So as a quick verification here, we're looking at 10 years of return data. We have a risk-free rate of 4%, and we have two funds. Okay? So Fund 1, Fund 2, and a benchmark. So the average annual returns, 12, 8, and 10%, Fund 1, Fund 2, and the benchmark. The standard deviations, 16% on Fund 1, 10 on Fund 2, and 14 for the benchmark. Well, if you want to calculate the Sharpe ratio, okay, so the Sharpe ratio for Fund 1 is simply going to be its return of 12 minus the risk-free rate of 4, okay, divided by its standard deviation of 16, right? Okay, all this in percentage terms. So that ought to be equal to 0.5, right? So there is the Sharpe ratio of 0.5. You're getting 0.5% excess return for every unit of risk, and we see it come up on the slide there. What about Fund 2? Well, that's going to be 8% minus 4% divided by 10, so that's going to give us a Sharpe ratio of 0.4. And then the benchmark portfolio has a return of 0.43. So given that we have all that, right, now let's look at what happens to Fund 1 if we either add cash to the portfolio, okay, or we lever the portfolio, right? So we short the risk-free asset to buy more of the portfolio. So portfolio, we could have 80% in Fund 1 and 20% in cash. Well, what's going to happen to return? All right, well, if we said, look, we have this portfolio, Fund 1, we have, instead of investing 100% of our money in it, we're going to invest 80% of our money in it. Well, invest 80%, there's the return on that portfolio, that 80% of our new combined portfolio, Fund 1 and cash. Okay? And then the rest of that, the other 20%, we're investing in cash or the risk-free asset, right, times 4%. So we're going to have a return now of 10.4%. Okay? Notice that the return went down. If we invested 100% in Fund 1, we earned 12%. If we invested only 80% in Fund 1, the rest in the risk-free asset, then we only earned 10.4%. But when we calculate the Sharpe ratio, well, the numerator is going to be the same. So it's going to be the return on our combined portfolio, 10.4 minus the risk-free rate. Okay, but notice that now as we start moving to cash, well, we have less risk. So because the risk-free rate has zero variance and zero covariance with all their assets, then the risk of the portfolio is just going to be 80% times the risk of Fund 1, and notice that the Sharpe ratio doesn't change. So the point here is to see that, yes, the excess return went down, okay, but the risk of the portfolio goes down proportionally. So adding cash to portfolio one, taking portfolio 1 and holding some portfolio 1 and some cash does not change the Sharpe ratio. Sharpe ratios are unimpacted by cash or leverage. We could also do it the other way. We could lever up. So instead of putting 100% of our money in Fund 1, we could put 120% of our money in Fund 1, right? Well, the problem is we only have 100% of our money. So if we're going to put 120% in Fund 1, then we're going to have to borrow some money, i.e. short the risk-free asset, and we're going to get a higher return, 13.6%. That means we're going to have more risk, okay? But the increase in risk is going to be proportional to the increase in excess return. So you can see here, and the point of the story, okay, I think it's an important point because we're going to contrast that with the information ratio in a moment, okay? But this is a fairly minor point, is that, look, you got a fund, you can either take the fund and add some cash, or you can lever it up, right, short the risk-free asset and buy more of it. Okay, that's not going to change the Sharpe ratio. And we'll see, we've seen this in the past when we were looking at the capital market line, for instance, right? Okay, so adjusting risk and return using the Sharpe ratio. So if we look at, we have these two funds, Fund 1 and Fund 2, expected return 10%, risk of Fund 1 is 14, so a Sharpe ratio of 0.57. Okay, Fund 2, 15%, a higher return, but we see that we have 20% as the standard deviation. Okay, well, that's too high, right? So it does have a higher Sharpe ratio. So we like investing in Fund 2, right? It has the higher Sharpe ratio. That's what you want. You want as much return per unit of risk as possible. So is it possible to invest in Fund 2, okay, and bring the risk down and still get this great Sharpe ratio? Well, what we were just talking about in terms of the Sharpe ratios being unimpacted by cash, well, we can, right? What we're going to do is we're going to take Fund 2, and we're going to buy some Fund 2, and we're going to invest in some cash, and that way we're going to end up with the same amount of risk as if we had invested in Fund 1, okay, but we're going to have the higher Sharpe ratio and therefore a higher return, right? So bearing the same amount of risk, but a higher Sharpe ratio means more return per unit of risk, so we've got to get a higher return. So the question then is, what percentage of cash would an investor need to hold? That is, how much would they invest in the risk-free asset, okay, in percentage terms, to reduce the risk of a portfolio invested in Fund 2 to have the same risk as an investment in Firm 1. So we can put 100% of our money in Firm 1. Okay, we have an expected return of 10%, and we have a risk of 14%. We also, our Sharpe ratio is only 0.57. Well, a better alternative would be to invest in the fund with the higher Sharpe ratio, okay, and then to take a cash position to bring the risk down to an acceptable level. In this case, we're defining the acceptable level as 14%. Well, how much would we need to invest in the fund, and how much would we need to invest in cash? Well, it's a simple ratio, right? So we've got this 14% standard deviation in Fund 1 of 20 in Fund 2. Well, because when we take out of the risky investment and put it into the risk-free asset, okay, well, we're going to end up with just this linear combination. So 0% times the risk of, the investment in cash times the risk of the risk-free asset, which is, of course, 0, and then the weight that we're putting in the risky asset times its standard deviation. Okay, well, it turns out that if we just take the ratio, we'd like to have 14% return. Okay, but 14% standard deviation, but the fund has 20%. Well, 14 is 70% of 20, so 70% is the answer to the question. What we want to do is we want to put 70% of our money into Fund 2 and 30% into cash, and if we do that, we can see that we're going to earn a little bit higher returns. Expected return is going to be higher, but the risk is going to be the same, and of course the Sharpe ratio, okay, is going to be the same. So we get the higher Sharpe ratio, we get the same risk as Fund 1, okay, but we get the slightly higher return. So that's going to be the advantage of investing in Firm 2 and cash as opposed to investing in Firm 1, because you don't want to give up the higher Sharpe ratio. You want as much return much excess return per unit of risk as possible. All right? Okay, let's talk about the information ratio. And this is where things are going to start getting a little thicker. So we're kind of building here. We haven't seen much yet that we haven't dealt with either at level 1 or elsewhere in the curriculum at level 2. And in fact, this slide is not going to take us past what we've seen previously. Okay, but this is going to be the front end of stuff that's going to be new and perhaps a little intricate, right? So this is where Greenhold and Kahn and then Clark, De Silva, and Thorley are going to start messing up your life to some extent. Okay, we've already talked about the information ratio. It's come up in a couple of different places in the curriculum. Okay, we could compute it ex ante or ex post. Okay, and ex post, it's easy to do. There it is. We've got all the data. Okay, but remember, what we're doing here is we're talking about ex ante decisions. All right. So the information ratio is simply going to be active return. So the return on the portfolio minus the return on the benchmark. Okay, we're going to see that as R sub A. Right. So that A stands for active. Again, make sure you distinguish between the return on the benchmark, that's going to be R sub B, and R sub A, which is the active return, and the concept that we just finished talking about, that is excess return. Excess return and active return aren't the same, right? So any S&P 500 index has excess return. That's the return difference between, or the difference in return between the portfolio and the risk-free rate. All right. So we have active return in the numerator, and then our standard deviation of active return in the denominator. And of course, there's a big difference between an investor whose alpha is all over the map. Okay, sometimes big positive, sometimes big negative. Okay, and someone who consistently generates 2% return. Right. So what we're trying to do is understand what's happening in terms. Well, what we're trying to do is distinguish between who has generated alpha because of skill and who generates it because of luck. Because if it's luck, you can't count on that happening in the future. Okay? If it's skill, then maybe that's somebody that we would actually want to invest some of our money with, right? So anyway, so the information ratio, this is going to be active return per unit of active risk. So remember, when we're looking at, if you're looking at, the value of a portfolio over time, well, we can have the portfolio going up and down like this, right? So it's going to have some standard deviation. If it's an equity portfolio, the standard deviation is going to be really large. Okay? And if I had another color, I would change. But if we think of a manager who always generates a little bit of positive alpha, okay, well, then this would be the value of the portfolio for the manager, right? So this is going to be the return. Now it's going to be the return on the portfolio versus the return on the benchmark. Right? But look, the space between the two, okay, is always the same, right? Subject to the tolerances of my artistic ability, which are very limited. So in this case, okay, the RA, okay, the active return is just going to be the difference between the two lines, and notice how constant that is, right? So the portfolio can go down, the portfolio can go up. Okay, but if it's going up and down with the benchmark, the active risk here could still be very low. And the way I've drawn this, it's close to 0. So this manager always beats the market by 2% or whatever that would work out to be. So maybe thinking this dollars, maybe better to think of it in percent. But nonetheless, and either way would actually work. But nonetheless, the RA is just the difference. So the point is, while the risk of the portfolio, okay, even the portfolio for the manager that we're looking at can be really high. Okay, it's because the risk of the benchmark is high. What we're worried about is the risk of the actively managed portion, right? So or the risk associated with the active return. So in this case, okay, you've got whatever the RA turns out to be, and the risk would be really low. So this particular money manager from my picture would have an information ratio through the roof because you got big active return, and it's very, very consistent through time. All right. So anyway, so that's the idea with looking at active return versus active risk. So the fact that the portfolio has a big standard deviation, that's not what we're talking about. It's just the active portion that we're trying to capture here when we talk about the information ratio. So the information ratio, different than the Sharpe ratio. Okay, the information ratio is going to be impacted by leverage and cash. So if we put in leverage, okay, we put in cash, that is going to impact the information ratio, doesn't impact the Sharpe. Okay, what doesn't impact the information ratio, though, is I think the most important thing to understand. And that is that the information ratio is unaffected by the aggressiveness of the active weights. So the deviations you take from the benchmark, that's not going to impact the information ratio. All right? So let me show you what I mean. So if you take this and you say, okay, we're looking at the benchmark. Okay? So here's our securities. And we're just going to do 2 to keep it simple, A and B. So the benchmark is going to be 50 and 50, right? Again, to keep things simple. Well, we could have a portfolio 1 that's making active bets, right? So they could go to 60 and 40, right? And based on that, we could calculate what the information ratio is going to be, right? And I'm just going to put that it's equal to X, right? So the information ratio, and this is the portfolio for manager 1. Well, if we then look at manager 2, okay, so and this manager goes to 70% and 30%, okay, well, they've made more aggressive bets, right? So their return is likely to deviate more from the benchmark returns, because instead of only changing the weights by 10%, they've changed them by 20%. So manager 2 is making the same bets, but they're going to be more aggressive. So in this case, we're going to have different returns. Okay, we're going to have different active return, but the active risk is also going to increase proportionally. So what we would see is that the information ratio for manager 1 is going to be the same as the information ratio for manager 2. Why? Because if you take active return over active risk, okay, well, if you have if your bets are modest, you increase by a few percent, or your bets are big, you increase by a lot. Well, you're going to change both the numerator and the denominator, and you're going to change them proportionally. Okay, so the information ratio is unimpacted by the aggressiveness of the bets. So this is the low aggressive manager. This is the high aggressive manager. Okay, well, you're impacting numerator and denominator the same. So the size of the bets, okay, the magnitudes of the active weights doesn't matter, right, if we're talking about the information ratio. And in the end, one of the big conclusions is, and it was part of what we're working up to, is that investors, if you have an investor here and we're going to choose between different managers out there, choosing between different mutual funds, if you want to think of it that way, the investor is always going to choose the active manager with the highest information ratio, and it doesn't matter how risky the portfolio is, right? So what you want is the highest information ratio, and you can then change the aggressiveness just like we did with the Sharpe ratio, or just like we did with the portfolio and cash when we were talking about the Sharpe ratio, and we'll see that. So anyway, so big point here, the information ratio is unaffected, okay, unimpacted is what I was trying to say, by the aggressiveness of the active weights. Okay, so if you're increasing the active weights, well, you're changing both numerator and denominator, so they're going to change proportionally, so the information ratio is not going to be impacted. All right, now, let's think of this from your point of view, or my point of view. We're an individual, right? We're planning for retirement, and we're saving some money. And we have to choose people to manage our money for us. Of course, you may actually work someplace where you do that, so anyway, but if you're choosing these active managers, okay, well, when I look out at the mutual funds available to me, I can't adjust the active risk of the existing funds, right? The active risk of the fund is what it is, and that's, it's a deca-billion-dollar fund, and the managers are going to do whatever they want to do, and I've got like, $187 invested there, and so if I call them and say, hey, you need to bring down the risk, I love what you're doing, but bring down the risk, well, first of all, I'd never get past the call center, but I certainly can't impact the risk of the overall portfolio. But what I can do, right, so I can say, look, I have this idea that I want to be invested in the benchmark. Think S&P again, but the benchmark, all right? Well, if I have the benchmark, and then I've got managers that are using as a benchmark the S&P 500, I can invest in the S&P, I can invest in these actively managed portfolios. Okay, well, what I can do is I can split my money between the benchmark itself, which remember is replicatable, all that sort of stuff, S&P index, and these managers that benchmark to the S&P, right? So I can split my portfolio between the fund and the benchmark to achieve my risk goals, right? So if I want to decrease the risk, so I look out there and there's this mutual fund and they're generating, big active returns, and once I look at the information ratio is high, but man, they're taking more variability than I can take with my advanced years. Okay, well then what I'll do is I say, oh, look, I'm going to buy some of that fund, and the rest I'm going to invest in the benchmark. Right? And I'm going to be able to bring down the risk of the total portfolio by looking at those two components. On the other hand, if I say, well, you know, those guys, they're doing a really good job. I just wish they would take more risk because I've got a long time until I retire. Well, I can increase active risk by shorting the benchmark, just like you sold the risk-free asset when we're talking about the Sharpe ratio. I can short the risk-free asset and put the proceeds plus all of my money into this particular fund. Okay, so we're talking about the information ratio. The last thing on the last slide said the investor will always choose the manager with the highest information ratio for whatever the benchmark we're looking at. Well, and it doesn't matter how much risk the manager takes. Why? Because we can either decrease the risk by combining it with the benchmark or increase the risk by shorting the benchmark and doubling down on the fund. All right? So then that's actually a big point. We've seen something like this before. So when we looked at the capital market line, which is what we're seeing here. So this is the market with sufficient frontier. We had all these individual assets, and we kept combining them into portfolios until we came out with this curved line. So the curved line is the market with sufficient frontier. That is, those are the efficient portfolios if we only consider risky assets. And then we took this risk-free asset over here, and we said, look, maybe we ought to develop. Okay, so if we look at standard deviation against expected return, right? So we had all the individual assets. We got our Markowitz sufficient frontier. Well, Markowitz didn't consider a risk-free asset. So if we take this risky portfolio, and down here is the risk-free rate, right? So this is Treasury bills, or fill in your own downgrade joke. Well, remember, the risk-free asset had these unique properties where it was, has zero variance and zero covariance. So when we combined it with the risky portfolio, the portfolio combinations fell along the straight line. Well, then we just said, well, if we could do that, then we could also pick something higher on the efficient frontier, and we could do this, right? Well, this line, the higher line, dominates the lower line, right? So if this is the amount of risk you're willing to take, you can either have this much return, or you can have this much return, X or Y. What do you prefer? Well, if you prefer X, let me know, because I'd be happy to take some of your money from you. But everybody wants the higher return. Everybody would like to have Y. Okay? So what we were looking for is this portfolio tangency between the two. And this is how we develop the capital market line, right? And the point here is that the capital market line, the CML, okay, what's the slope of this line? Okay, well, the slope of the line is the Sharpe ratio. Okay, it's going to be the excess return, the return on the portfolio, minus the risk-free rate, okay, divided by standard deviation. So we did this CML thing, and we developed this and said, okay, here's the CML. This turns out to be the market portfolio, which has lots of implications for other things that we could talk about. Okay, but how do you use this? Well, remember we said, what if you could come up with a better portfolio? What if you could get a portfolio here, because markets are inefficient and you're a superior security selector, okay? Well, then you could do the same thing. You could get a line up here, right? And that's what we called a CAL previously, right? Capital allocation line. So this would have a higher Sharpe ratio. So what we're looking for is the line with the steepest slope. Right? So we're combining two assets here. Okay, one is the market portfolio and the risk-free rate for the CML. One is the portfolio, the actively managed portfolio, and the risk-free rate to get a CAL. Okay? And so we're combining these two assets and trying to get the highest possible Sharpe ratio. Well, we're going to be doing the same thing now, right? So here's back to the CAL. I guess here we're calling this the CAL. So this wouldn't necessarily be the M, but if you make this the market portfolio, okay, then this becomes the CML, the capital market line that we've talked about elsewhere, right? So anyway, we have this, we are able to say, look, here is our Sharpe ratio. If this is the best portfolio we can put together, then we have a CAL. If we could do something over here, right, then we could even get a higher CAL. So that's one of the ways we looked at evaluating money managers. Well, the point here is that we're going to be doing something similar when we're choosing between the benchmark, okay, and the portfolio. That is the actively managed portfolio, right? So what the objective here is always to have the highest possible Sharpe ratio. You want as much return per unit of risk as you can possibly generate, all right? Okay, this is where we're going to start adding some equations to your equation sheet. So, and it's not that many, I don't know. It depends on how you count them, 10 or 12 formulas we're going to see over the next little while. But these are things that I think are testable, and I think maybe even with some, I guess my opinion would be reasonable enough likelihood that you'd probably want to put these on your formula sheet. So anyway, so the Sharpe ratio of an active portfolio. So an active portfolio says, hey, we're going to take, we're going to take the fact that the markets are inefficient, we're going to put together the best portfolio we can, and we're going to know the information ratio. For us as investors, we're going to say we can invest in the S&P 500 index, or we can invest in the S&P 500 index and an active portfolio in some combination. Well, the Sharpe ratio of the combined portfolio, that is the Sharpe ratio for the portfolio we're going to get when we combine the benchmark and the active portfolio, the Sharpe ratio squared, right, is going to be the Sharpe ratio of the benchmark squared plus the information ratio squared. And this drops out of the portfolio math, and you have to be really good with all the, it's not in this one, but variance, covariance, we could do this in matrix form. It'd be a lot simpler, but that's not part of the curriculum. Anyway, the point here is that's probably just something you're going to want to memorize, right? You can derive it. It's fairly intuitive if you do that, but it takes a while to do. So what we want is we want to maximize this thing, right? We want to get the highest possible Sharpe ratio. Well, the amount of risk, the amount of active risk that we can take that's going to maximize the Sharpe ratio is given by this formula, right? So the optimal active risk, so risk, standard deviation, the asterisk means optimal, and then for the risk on the active portion of the return, it's going to be the information ratio for the fund divided by the Sharpe ratio of the benchmark times the variation in the benchmark. All right. So what this is what this does is gives us the amount of active risk that we want to take that is going to give us the maximum possible Sharpe ratio. Okay. So I think that this particular formula is important. The one above it is important, and the one below it is probably important too. Okay. But this idea of the optimal amount of active risk is going to be really important. So here's what we're going to see. We're going to have this fund, right? Which we're calling P, right, the portfolio. And it's going to have some characteristics. It's going to have some active return, but it's also going to have active risk. So if we look at this and we see that the active portion of the risk is, I'm going to call it 10%, right? So that's the standard deviation. That's the active risk, the standard deviation of the active return. Well, what happens if we go in and calculate the optimal amount of risk, right? So we go in for our portfolio and we say, well, the optimal risk is equal to 15%. Okay, well, what do we want to do? Well, we want to buy enough of this so that we can increase the amount of active risk that we have in our portfolio. So we're going to combine the benchmark and the portfolio, okay, in such a way that we're going to create this amount of optimal risk, and when we do that, that will give us the maximum Sharpe ratio. All right? So if we have the fund, it has an active risk of whatever it is, okay, based on the fund's active risk and how it fits into its information ratio, the Sharpe ratio of the benchmark and the risk of the benchmark. Okay, well, then we're going to be able to calculate this 15% number. We want to be able to combine the benchmark and the fund in such a way that we get this amount of active risk. Okay, I'll put an A here, the optimal amount of active risk. Okay, and when we do that, okay, when we force the active risk to be equal to this, that's going to give us the maximum Sharpe ratio. All right? So the Sharpe ratio maximizing optimal level of active risk, okay, for an unconstrained portfolio. We're going to talk about constrained versus unconstrained in a while. All right, so anyway, you want to make sure you have a handle on this, the optimal amount of active risk, information ratio divided by the standard, the Sharpe ratio of the benchmark times the standard deviation of the benchmark. Okay, and then finally here, if we do combine these portfolios, that is the active portfolio and the benchmark, okay, well, the variance of the portfolio that we are combining here, okay, is going to, of the two assets, the benchmark and the fund, is going to be the variance of the benchmark plus the variance of the variance from the active risk of the fund. Does that make sense? I didn't say that very well. So the variance of the portfolio, okay, some combination of benchmark and fund, okay, is going to be the benchmark of the portfolio, is going to be the variance of the benchmark of the portfolio plus the active risk, stated as variance here, for the fund. right? So the total portfolio return volatility is going to equal the benchmark return volatility plus the volatility of active return, not total return for the fund, right? So just the active portion of it, and the fact that these things are uncorrelated is why this turns out to be so simple. So all we have to do is add them together. Here's the risk of the benchmark, here's the risk of the active risk of the fund. Okay, put those two things together, and that's going to give us the active risk of the portfolio, all that stated as variance. So let's try this, and this is kind of a long example, but I think being able to work through this example, this goes through, I think, 3 or 4 slides. Okay, if you get to this point, okay, you get through this example, then you're ready to move forward. Okay, if you find this befuddling, then I would go back and look through this again before I jumped into the next portion where I was adding the idea of the information coefficient instead of the information ratio. So we'll see that coming up. All right, so let's try this example. So here we have a fund. It has an information ratio of 0.4 and it has active risk of 6%. So that's the active risk. Okay, remember the volatility could be really high, but we're just looking at the active risk. And we have a benchmark. The benchmark has a Sharpe ratio of 0.5, total risk of 12%. So what is the optimal level of aggressiveness? Well, remember, the aggressiveness means how much of our money do we want to invest in the fund, okay, and then how much in the benchmark. So that's going to be the optimal level of risk, optimal level of aggressiveness, the same thing. So here's our formula. Remember, this is the optimal level of active risk is going to be the information ratio of the fund divided by the Sharpe ratio of the benchmark times the standard deviation of the benchmark. In this case, we need the optimal amount of aggressiveness is 9.6%. So what that says, if we put 100% of our money in this fund, the active risk is going to be 6%. We think the optimal level, the Sharpe ratio maximizing level, okay, is greater than just to take more active risk than 6%. Okay, based on all this ex-ante projections, and assumes we have some confidence here. We'll talk about that later. Okay, but we want more. So how are we going to get that? Well, we're probably going to put more than 100% of our money in the fund, right? We got to up the amount of active risk that we're exposed to here if we want to maximize the Sharpe ratio. All right, so anyway, so this is our first calculation. Okay, 9.6%, that's the optimal amount of risk. Well, if we do that, what's going to be the Sharpe ratio? Okay, what's going to be the Sharpe ratio of our portfolio with this optimal level of aggressiveness? Okay, so that's this formula where we're going to take the Sharpe ratio squared is going to be equal to the Sharpe ratio of the portfolio squared is going to be the Sharpe ratio of the benchmark squared plus the information ratio squared is equal to 0.41. But remember, this is the Sharpe ratio squared, so we've got to take the square root of both sides here. So the Sharpe ratio is going to be 0.64. So here's the point. Okay, if we take and we have this option. We have a benchmark we can invest in, and we have a fund we can invest in. Okay, the fund has an information ratio of 0.4, active risk of 6%. Well, if we can invest in those two things, and if we can do it optimally, right, we can increase the Sharpe ratio. In fact, if we can invest in those two things, the benchmark and the fund, in such a way that we can create active risk of 9.6%, then we're going to end up with a Sharpe ratio on our portfolio of 0.64, and there is no other amount of active risk that's going to give us a higher Sharpe ratio. So what if we went to 10% for active risk? Well, that's going to end up decreasing the Sharpe ratio. What if we went to 9% instead of 9.6? Well, that would decrease the Sharpe ratio. Okay, so here we have the optimal amount of risk. That is the Sharpe ratio maximizing level of risk is 9.6%. Okay, if we put that into our portfolio, and so we combine our portfolio optimally, then this will be the Sharpe ratio of the portfolio. That assumes optimality here, meaning that we have the optimal weights between the two, the benchmark and the fund, and that's going to give us a benchmark. It's going to give us a portfolio where rather than earning 0.5% return for every unit of excess 0.5% excess return per unit of risk, we can earn 0.64% for every unit of risk, right? Of excess return for every unit of risk. So we are able to maximize the Sharpe ratio by combining these two optimally, all right? Now, the optimal portfolio has active risk of 9.6%. That's what we just said, compared to the active fund, the fund's active risk of 6%. So how do we do that? Well, if we need risk of 9.6%, okay, and we only have 6% risk in the active portfolio, well, that tells us that we need to invest 160% of our money in the actively managed portfolio. So here we get 1.6. That says, okay, as proportionally, we want to invest 160% of our money in the actively managed portfolio, but we only have 100% of our money, right? So that means we're going to have to invest minus 0.6% or take a short position in the benchmark. So we're going to short the bench, and we're going to invest 160% in the actively managed portfolio. Now, let's go back and verify the Sharpe ratio. So remember, we had a Sharpe ratio of 0.5 on the benchmark. And we calculated that if we combined it, the benchmark and the actively managed fund optimally, then we would get a Sharpe ratio on the portfolio, benchmark and actively managed fund, of 0.64. So let's go back and verify that to make sure it's right. So remember here that the original, from our example, the actively managed fund only has active return of 2.4%. Okay? And you haven't actually seen this formula yet, but it's one that you're going to need. So the expected active return is going to be the information ratio times active risk. So it's going to be 0.4. That was the information ratio times active risk of 6%. So that's 2.4%. That's going to be the active return on the active return on the fund. So going back, we can think, okay, what's the expected active return here? Right? Well, it's going to be the information ratio times the active risk. So 0.4 times 9.6 is going to be equal to 3.84. So remember, now this is an optimal amount of risk, right? So this is for the base portfolio. That's for the fund before we did any leverage or anything like that, before we were shorting the benchmark to buy more of the fund. But if we take this and say, look, we know what the optimal amount of risk is. We know the information ratio. So if we take the information ratio times the risk, well, if we did that for the fund itself, that's what you have in the box over here. Well, if we just put 100% of our money into the fund, then the expected active return would be 2.4. But we're doubling down on this active fund, right? But we're ramping up on active risk. So we're going to take 0.4 times this risk level that we are building. Okay, we're building there because we calculated it to be optimal. And that gives us an active return of 3.84%, right? So in our new portfolio, right, in the new portfolio, we've already calculated the Sharpe ratio. Okay, the Sharpe ratio is going to have is going to be 0.64%. So the active return portion, that's going to be 3.84. Okay, well, let's see, the Sharpe ratio for the benchmark, it's going to be the excess return on the benchmark divided by the standard deviation of the benchmark. Well, we know this, right? So we already know that was 0.5. This was given to us as 12%. So the excess return has got to be equal to the Sharpe ratio times the standard deviation of the portfolio. That's just a little bit of arithmetic, right? So if we plug all that in, what we see is the excess return here is going to be 6%. That's the excess return on the benchmark, excess return above the risk-free rate. RB minus RF is going to be 6%. So in this case, the excess return on the portfolio, notice that this is excess and not active, right? The excess return is going to be what we would get on the benchmark plus our active return that we calculated from up here, right? So the excess return, not the active return, the excess return is going to be 9.84% for our optimized portfolio. All right? There's lots of scribbles on this page. So let me get rid of some of this really quickly, and let's go back and summarize. I think this is important to make sure you understand. All right? Okay, so we have this formula we haven't seen previously that I think you do need to know, all right? So, and that is that the active return or expected active return is going to be the information ratio times active risk. So for the fund overall, that's 2.4. We're not buying the fund overall. We're optimizing the combination of the benchmark and the fund, and we're going to do that in such a way, 160% fund minus 60% in the benchmark was what we calculated, so that we have active risk of 9.6%. So the active return is going to be the active risk times the information ratio, okay, is equal to 3.84%. And then we were able to do a little bit of arithmetic to find that the excess return, not active, excess return on the benchmark was 6%. Well, okay, so if you just bought the benchmark, you're going to earn 6% above the risk-free rate. Okay, that's the excess return. But we're going to take to that 6% and add active return of 3.84. So that gives us portfolio. Okay, that is combined 160% fund minus 60% benchmark. The portfolio excess return is going to be 9.84%. Well, what is going to be then the Sharpe ratio? Okay, well, the portfolio, we can calculate total portfolio risk. This is something else. We did see this formula earlier. We saw it written slightly different. We didn't have the radical in there. So we looked at the portfolio's variance is equal to the variance of the benchmark plus the active variance, right? So 9.6% squared. So here we're just saying portfolio risk, and then we're taking the radical and putting it over the variances. So we're going to have the 12% squared as the variance of the portfolio. The 9.6% is the variance of active return. Add those two together, take the square root, that gives us 15.3675%. So now we know two things. Okay? We know that the excess return was 9.84. We learned that on the last slide. And now we know the risk here, okay, just from applying this formula that we've seen previously. Okay? And we can calculate the new Sharpe ratio for the portfolio, 160% fund, minus 60% benchmark, and we get back to this 0.64. So what we were doing here, of course, is verifying the Sharpe ratio. So we knew the Sharpe ratio already. We calculated that way back on the second slide when we first started doing calculations. Okay, but now we can see that once we plug all through this, we find the expected active return, we find the excess return from the benchmark by itself, we put those two things together, we calculate the risk. Well, in fact, we do have a portfolio that instead of giving us a benchmark Sharpe ratio of 0.5, which is what we were given in the data, okay, we can actually create a portfolio that has a Sharpe ratio of 0.64. Okay, we've optimized the combination of the two. So let's take a quick look here at this one more picture to sort of summarize what's going on here. So if we think of this as the risk of the portfolio, and here the forecast excess return. Again, it's not active return. So if you just buy into the index, you're a passive investor. You're still hopefully earning something more than if you invested in T-bills, right? So it's just RP minus RF, or in this case, I guess RB minus RF if we're just thinking of the index. Well, here's the point. So the Sharpe ratio is a slope. So if we looked at the benchmark portfolio by itself, well, there it was. Okay, it had a forecast excess return of 6%. It had variability of 12%. Well, we could move up or down. If that was my option, right? So if we went back to the capital market line, okay, and we saw that that was the point of tangency, right? So we had this portfolio M. Okay, well, we said, look, if that's too much risk, you can move up and down. Now, this doesn't assume that this is the, I'm going to get rid of that because that's not the assumption we're making here. But nonetheless, we've already seen this idea, so you can think of this as creation of a cow. We have this portfolio. Well, if that portfolio has too much risk, then you can take that portfolio and you can move down here, you can move up here. The point is, you're going to keep, you can increase or decrease, lever or hold cash, and you can move anywhere you want on this line, right? Okay, so that's what the calculation of the Sharpe ratio was. We want the highest possible Sharpe ratio. Well, what we're saying now is that we could take this actively managed fund, okay, and combine it with that benchmark, okay, and we can get something that's up here, right? So we can get, we have a standard deviation of 15.37% and an excess return of 9.84. Well, that's the optimal combination. We don't have to buy that portfolio. We could still lever down or lever up again, but the combination that optimizes the Sharpe ratio, okay, is the one where we have risk, in this case, of 9.6%. Okay, we found that that gives us the highest Sharpe ratio. Okay, well, what we've done here is found what we should invest in terms of our risky assets, the benchmark and the actively managed fund, and then we can move up and down this cow just like we would any other cow. So this is just looking at the risk and return, excess return against the risk of the portfolio.